Hello and welcome to today's Scope webinar. I'm Barbara Claus and I will be your host today, and our theme will be dividend investing in ESG. These are two themes that sounds a bit controversial for many of us, because when you think of dividend stocks, it's often traditional sectors like energy or utilities where you have the highest dividend yields. And today, core theme is how we bring that together with ESG factors. And therefore, we have a fund manager, Nicolas Simar from NNIP there, who has been managing European dividend strategies since 1999 and integrates dividend investing into his approach. During the webinar, we will also touch on another theme, which is behavioral biases, which are included into the investment process. And we'll also ask Nicolas why he includes these factors and what they are helpful for during the process. For you as participants, you will also have the possibility to ask a question to the fund manager. So if you have a question, please type them into the chat window on the right side, and we will get back to your questions during the course of the webinar or at the end of the webinar in our Q&A session. So thank you all for being here today. And also, Nicolas, hi. Great that you are here today, and we are really curious about what you tell us about dividend investing and ESG.
Good morning, Barbara, and thanks for this introduction. And indeed, I mean, I've been managing those dividend strategies for more than 20 years. And as you said, a lot of people still believe that dividend investing and high dividend investing only means investing in the highest dividend yield names. But I think that the goal of this strategy, and I think it's important to stress that it's not a yield maximization process. So really the idea of that strategy, whether it's on the Eurozone or on a pan-European universe, is really to build a diversified portfolio, offering attractive yields, but yield that we believe that are financially sustainable. So there again, it is not a yield maximization exercise. And you will see that in our process, we have some tools that helps us, I would say, to avoid having those unintended biases that you mentioned, like structurally overweight utilities or telco, which for some reasons you might not always want to be overweight. So there is more flexibility in the way you can manage a dividend product than just looking for the yield maximizations. And maybe if I can just show you one slide, just to explain a little bit what we do. And it's clear that having a dividend tilt will provide you a value tilt in your strategy, but at the same time, by looking at dividend sustainability, as I said, you bring a quality tilt to your strategy. So within the value pockets, I would say that those strategies typically have a higher quality tilt, which is reflected by a lower volatility versus value peers, better drawdown management versus value peers. And at the same time, it's true that despite managing the strategy for more than 20 years, we've been also enhancing the process over time. And just give you a few points here. It's clear that the ESG integration and basically the assessment of the most material ESG risk and opportunities is also a way to improve the quality of your stock selection process. And we will probably come back to that point, how we do that practically in our process. It's important to know that despite having this value tilt, we are also able to achieve a non-financial target, which is targeting a lower carbon intensity versus the benchmark, whether you take the MSCI EMU for the Eurozone fund or the MSCI Europe for the pan-European. So you see that by having the right approach, you can commit to have a value tilt, to have a dividend tilt, but at the same time having non-financial targets like lowering carbon intensity versus the benchmark. And as you said, another tool that we used quite significantly over the last 2-3 years is basically analyzing behavioral tilt. Every portfolio manager has behavioral tilts, and it's important to know what are those tilts and how you can basically improve your product performance by properly managing those tilts. And there again, working with an external counterparty has helped us improving our biases, and especially the loss aversion tilt. I mean, a lot of portfolio managers have a tendency to avoid taking their loss on a position that has not worked. That has been highlighted specifically for us. And by properly analyzing that, we have been able to improve that. But we will come back to that point as well during this call.
Yeah, thank you very much, Nicolas. We definitely pick up on that theme, behavioral biases, and how they impact fund management later on. Before we start, I think you had a rough time with the dividend strategy after 1999 for most years, as value have underperformed. What have you experienced, and how did you navigate your strategy during these times? Also, in regard of the quality tilt, has it helped during those years?
So it's absolutely correct. I mean, when we launched the strategy, and maybe you've got just one chart here that really highlight what has happened over the European markets over the last 20, 30 years. It's true that remember in 99 we had that TMT bubble, extreme valuation dispersion in the market, and of course we had, I would say, the best period for value investing from March 2000, the peak of the previous TMT bubble, until probably, let's say, the great financial crisis, 08, 09. And since then, it is true that apart from some short episodes where value did well, we've seen a kind of structural trend of underperformance of the value style. And what you can see on the chart on the left-hand side, if you look at the valuation dispersion within the market, so basically we look at the gap, the valuation gap between the most expensive part and the cheapest part. Well, you can see that we've reached lately this area, whether you look at the sector neutral or non-sector neutral, does not matter. We've reached a point where those gaps are extreme, as big or even bigger than when we launched the strategy at the peak of the TMT bubble. So the behavior over the last 3-5 years clearly highlight the difficult period we had for value. But to answer your question, I mean, the way we did navigate properly this period is really, as I said, by enhancing on the investment process. And I would like three key bullet points here. The first one is behavioral biases, as I said. The biggest risk for a value investor is to fall into value traps. Basically, you buy a stock, you believe it's cheap, that it will recover. You wait for the mean reversion to happen. But sometimes you do not recognize that the investment case has changed. And having a proper systematic review of the potential names that fall into that basket can help you having too much exposure to those value traps. So that's the first point. The second point is really a much better usage of risk models. A lot of portfolio managers basically know the absolute level of risk versus their benchmark, but they don't look in details to the underlying drivers of that risk. Is the risk driven by stock-specific risk? Is it driven by sector deviation? Is it driven by factor exposure, by country risk? And so by using a risk model and doing ex-ante simulation, so basically trying to see what will be the impact of an introduction of a name in the portfolio to the risk model is a nice way to avoid unintended risk. So this is a product that has an overweight to the value factor, an overweight to the dividend factor, because that's our belief for the long run, and we want to be overweight those factors. But at the same time, you want to make sure that by doing so, you do not take other risk in your portfolio, like being structurally underweight quality or being structurally overweight volatility. Usually, value stocks tends to be more to have a higher volatility score than the market. You need to make sure that when you build your portfolio, you avoid those unintended risks. And I would say the third point is really, as I said in the introduction, this is a strategy that does qualify as what we call ESG integrated. So Article 8, according to the SFDR regulation, which means that this is not an Article 9. This is not a fund that has a sustainable objective like impact strategies. But this is a fund where we properly assess the most relevant ESG risk per sector, per companies, and try to translate those risks into the impact to fair value. And I guess that by analyzing those risks, you increase the quality tilt of your portfolio. And I think that if you can combine a value tilted proposition, but at the same time avoiding the lowest quality part of the value universe, it tends to help you navigate, let's say, this most difficult period we've seen for value, as you rightly pointed.
Yeah, thank you very much, Nicolas. Before we dive into the process of the fund, I have a general question about the merit of dividend strategies. We have just seen that value and growth spread being at all-time highs. So this might definitely be a point about it, but maybe not a point for the timing, because you never know how long it goes on, and the market can go longer against you than you expect. So, but with the other merits, can you tell us a little bit about the general merits of dividend strategies for investors?
Yeah, well, I think that's you're right. I mean, and again, I mean, don't forget, and I come back to that slide here, which clearly, as you've pointed, I mean, this valuation dispersion is extremely high. But valuation dispersion, as you can see, it can take longer before the market realize that it's getting extremely expensive on the one hand and extremely cheap on the other hand. And therefore, what my point is that value alone is probably not enough. It's not the catalyst. You need catalyst basically, because as you can see on the right hand side here, the relative performance of value has been extremely bad the last 3-4 years, despite earnings revisions basically that were in line with growth stocks. So my point is that there is extreme derating. The fundamentals have not deteriorated, but nevertheless, value has underperformed. So besides the kind of adaptive investing that we've been implementing in the portfolio to help us navigate, I think that you still need to keep in mind that over the long run, and here I'm talking really for long-term investment horizon, value as a positive equity return premium that has been proven over the long run. But once again, it can take longer. It can take very long time before this reversion happens. So in the meantime, we believe that by having a dividend tilt, you provide, compared to other more devalue strategies, you provide a quality tilt. You know, when we select stocks, and that's where I think the dividend factor is an important one. You focus on the cash flow sustainability, the cash flow generation sustainability of a company. We know that a company will not be able to grow its dividend if it at the same time is not able to generate cash flow growth. So again, I think that versus a deep value strategy that will do extremely well when you've got the value rebounds, but you need to wait for a long time or to time extremely well. By adding this dividend angle, you bring more stability, you bring more predictability of cash flow. And in the end, those cash flow, the predictability of cash flow will be able to support dividend growth. So again, it's not only the highest yield, as I said, it's really attractive yield, but dividends that can grow over time. We're not interested in chasing the highest names if the company is not able by the cash flow generation to support those dividends. So in a nutshell, the dividend angle, if you do that properly, if you focus on the sustainable dividends, can bring a quality tilt versus your pure value exposure, I would say.
Thank you, Nicolas. It sounds really interesting, but we are also interested about the strategy, how we integrate ESG.
Yeah.
And my first question about the ESG integration is what resources you have at NNIP for company analysts, for example.
Yeah. So there again, I mean, it's an important tool, and I mean, we've got a full RI policy, and I've got just one slide that basically summarizes our RI framework. And what you can see from here is that basically we've got four pillars in our responsible investing approach, and it all starts with some restrictions, and in terms of resources, besides, I would say, our buy-side analysts. That focus on the day-to-day fundamental analysis of stocks sector by sector. We've got a team of 7 buy-side analysts and 2 data scientists only focused on European equities. Besides that, we've got a RI team of analysts engaging with companies on those most material ESG risk and opportunities. But if I can just summarize here a little bit the overview, because a lot of people believe that ESG integration is just about exclusion. Well, I would say that was probably the version 1.0 of ESG integration, and that's probably the easiest part, excluding some sectors or some activities. And indeed, we have, if you look at our approach, we have, as I said, 4 pillars. The first one is the restriction. So we have basically just need to move to the next slide here. Let me do that. We have a norms-based exclusion approach. So that applies for those strategies. So if, for example, some behaviors or activities are not in line with our ethics in principle, we will exclude those companies from the portfolio. And you can see here that activities like tobacco productions, oil sands, thermal coal, controversial weapons are excluded from our universe, because basically we believe that engaging with those companies will not deliver any improvements, and therefore there is a small area of the universe that we exclude because we believe that those companies are in violation with those principles. But as I said, the exclusion is only one side of the equation, and we believe that besides that, I struggle a little bit to change the slide, but here is it. Okay. Besides that, it's important to put your capital at work, and we prefer. I mean, excluding is easy. You exclude, but then you don't have any impact anymore to the company to improve the behavior of the company. So therefore, the second pillar is really engagement and voting. And we, for example, we do not exclude conventional oil from our portfolio. We prefer to engage with those companies and to support basically their transition from being an integrated oil towards an integrated energy company. So it means that for companies like Shell or Total, which by the way are leaders in their peers, if you compare the European integrated companies compared to US players or emerging markets oil companies or national oil companies, it's clear that they have really embraced that climate transition plan, and they do commit to the Paris Agreement. But it's not a simple process, so you cannot have a simple answer by just excluding any companies that wants to migrate from being a pure oil and gas company into a more integrated energy company. So yes, we do engage with Shell on their climate transition plan. We do engage with Shell, and this is done by our RI team in cooperation with our buy-side analysts. We do also engage on their remuneration policy. Do they have KPI targets that are aligned with their climate transition plan? And we believe that we have more impact and more influence by having an engagement than by just excluding. The third pillar, besides exclusion, engagement, and voting, is really the ESG integration. And that's really I would say the in-depth work which is done by our buy-side analysts. And the idea there, in a nutshell, is how you can basically assess the most relevant, the most material ESG risk for a sector or for a company. How can you translate that into an impact to the fair value? And those dimensions can be different sector by sector. It's clear that for I would say sectors like materials, industrials, energy, utilities, the focus on the carbon intensity is of extreme importance, because we know that those companies will have to face the cost of carbon in the next few years. So if you do not properly assess that cost, you might have a wrong financial outcome for your assessment of the company. But on other sectors like financials or healthcare, it's probably more about the governance. It's probably more about the product responsibility, where you need to put the focus. So I think an example is probably more relevant than just. Oh, sorry, I did a mistake here. I cannot see the slide anymore.
I can see the slide. So
yeah. Okay, I'm back.
Yeah.
I'm back. So if I come here and I change to the next slide, I've got two examples just to highlight a little bit the ESG integration process in our fund. And I've taken two examples, basically in two different sectors. One which is an example in a materials space, which is a pulp and paper producers, UPM. And what I want to highlight here is that this is really the work done by our analysts, and you've got here basically this kind of price estimates of the share price, 35 euros. So you see that basically based on the work of our analyst, he ends up with a kind of 35 euro share price target for the company. But if you properly assess all the risk, and amongst those risks, you've got the doubling of the CO2 cost over the next 3 to 5 years, you can see that it does have a kind of 5 to 6% impact to fair value. So my point here is that beside a base case fair value of 35 euro per share, integrating all the other risks, including doubling of carbon costs, including the fact that that company will have to invest into what we call environmental capex. They will need to invest to make sure that they will reduce carbon emissions in the future. You end up with a fair value which is a little bit lower. But at the same time, and that's the green part here, there are some opportunities as well, like investing and ramping up the biorefinery plant that could add some value. And cherry on the cake, but we've not integrated that into our base case assessment of the company. You could even imagine that as this company has a lot of assets in forests, you could add a little bit of value, but there you could need to take that with a little bit of prudence, because we could have some kind of carbon capture premium that you could add to the fair value of the company. So my message here is that our analysts, and this is not sector by sector, and of course, as I said, cyclical sectors will have more a focus on the carbon costs. Other sectors will be more focused on governance or on social aspects. But we do assess the risk. We do assess the most relevant risk, and we translate that into a fair value to the company. And that's where I believe that besides exclusion, besides engagement with the companies, I think that this is for us a very interesting way to properly integrate ESG risk and opportunities into your modeling. And the second example I wanted to highlight is more in the healthcare industry, where basically what we do here, and that slide might be a little bit complex, but the idea is very simple, is we have an NNIP, what we call ESG lens, which is a kind of proprietary corporate assessment score for all the corporates we do cover. And we try to assess if companies that do score well or do score bad on that score should deserve a kind of cost of equity premium or discount to the modeling of the fair value of the company. And there you can see that our pharma or healthcare analysts basically use that that NNIP lens score to properly assess the score, the risk, and then on a fundamental and qualitative assessment, makes an assessment if that's cost of equity premium or cost equity discount is warranted. And you can see, for example, that in that universe, Bayer and Sanofi are two companies where we believe that indeed, because of some specific controversies on the case of Bayer or product responsibility for Sanofi, we believe it's deserved to apply a cost of equity premium, to a penalty, sorry, to the fair value of the company. And again, it does not mean that we cannot buy Sanofi, but it means that the fair value and the upside to fair value does take into account those risks. And I think that's probably a more clever way to integrate ESG risk than just excluding sector based on a external score provider. So this is a little bit what I wanted to say about the ESG integration process we have. And I think it's quite unique to have that done sector by sector by our analyst in cooperation with the RI team. So it was a very lengthy answer, but I think it's important to make the difference between very simple exclusion rules and a more qualitative assessment and impact to fair value by our buy-side research team.
Great, thank you very much, Nicolas. I would sum up the key points for our participants of your process. So you use some exclusion criteria which are not very strict, so they don't limit the investable universe very much, but you factor in your ESG analysis on a company by company basis, looking how the company does in certain aspects, not only the environmental aspects, but also social and governance, and then calculate like a premium or discount to the fair value, and then arrive to a value for the company. And this really determines whether you invest in the company or not. And so my next question would be about the integration of behavioral biases, how you integrate them into your approach and why they are so important in your view.
Yeah, that's another tool I think that helped us to navigate those difficult years for the value style. And the idea here, as I said, was to work with an external counterparty, Essentia Analytics. And the good thing is that, of course, I've been managing that strategy since inception. We've got a long history of trade activity. So it all started by basically providing the history of trade to that company so that they can make an automated analysis of all those trades. And basically, try to identify, as I said, potential behavioral biases, tilts. Every PM has tilts, and those can be different from one PM to another one, and try to assess which type of decisions basically we do systematically well, and which type of decisions we basically do systematically poorly. And there, just to give you a quick summary and overview of the analysis, we started to work with Essentia a little bit more than 2 years ago, and they basically analyzed nearly 10 years of trade history of real trades in the portfolio. So that's, I think, where the added value is coming from. And I will maybe mention not all the items here, but 3 items where we believe it's relevant. One positive items, and that's the first point here, is that we systematically, as you know, as a value investor, we have a tendency to rebalance a portfolio to the mean. So basically, taking profit on the outperformance and adding to the underperformers in the portfolio. And based on their analysis, this process that we do systematically has been a strong source of positive alpha to the portfolio. So that's one of the positive tilts we have, and that we should keep basically continuing doing in the future. Another interesting analysis was what they call here the alpha life cycle analysis, the peak profitability. So they look at trade episodes. A trade episode is really when you enter a position in a portfolio until the exit. And they try to see at which time we reach the peak profitability. And in our case, it seems that after a kind of 15, 16 months holding period, we've reached the kind of peak profitability. So those stocks have outperformed, but after 15, 16 months, they don't deliver a lot of, they're running a little bit out of steam, if you like. So it's interesting for us now to receive on a monthly basis a list of those names that are in the portfolio right now that could fall into that category. And not that it will automatically imply that we need to sell, but at least we systematically review those names and assess, okay, maybe it's time to take profit on that name, remove the name, and maybe reinvest in other names where we might have more potential upsides. So that's an interesting factor that we receive. And the third example I want to highlight is really probably for us the most relevant is what they call the vulnerable position list, the VPL. And I was referring to that into the introduction, is how to avoid loss aversion bias. I mean, value managers tend to have that pitfall of selecting a stocks. It does not work. You don't want to recognize that the investment case has changed, and you become a little bit stubborn, and you want to keep waiting for mean reversion. Well, based on their analysis in the past, names that have had 15% relative underperformance versus the benchmark and that did not recover from max drawdown, if we would have exited more quickly those names from the portfolio, that would have added significant performance. So it means that we now receive also on a regular basis a list of names that we own in the portfolio as of today, and that could potentially fall into that VPL list. So names that we have introduced that have not worked, that fall into that category. And again, it is not a quant process, but systematically reviewing that list of names that potentially could fall into value traps and taking maybe more often action on those names is an important improvement in our process. And for example, we did the analysis last year during the COVID crisis. We did compare a buy and hold portfolio as of Feb 2020 and compared to the portfolio, the real portfolio. And we saw that getting quick or being faster to take action to close or losing position has been a substantial source of alpha during that difficult period of 2020 for the market. So there again, it's not the holy grail, but it is a tool that we use on top of our fundamental. It remains a bottom-up fundamental driven portfolio, but those are kind of systematic review of your biases, and that can help you to improve your trading activity. And again, each PM has different biases. So what is true here for our strategy might not be true for other PMs, other style, other strategy. So it's important to really make an in-depth analysis on the real portfolio, on the real trades. That's where you can draw any relevant conclusions, I would say.
Yes, thank you very much for explaining. So it's like a kind of a feedback loop for you, because we also see in practice, we see it always that people, they cannot get rid of their behavioral biases, because it's emotional, it's ingrained in our nature. So it's always good to have like an external control or a list or kind of a feedback where you can at least be aware of your biases. And then when you're aware, you maybe can also include these into your investment decision. And it's good to hear that it has paid out during the pandemic. And yeah, it's a really interesting topic that might be helpful for the investment decisions going forward.
Absolutely. Yeah.
The next thing I would move on to is the portfolio, and here I think there is a theme I would like to talk about because it's a really important theme. A theme which is discussed a lot at the moment is greenwashing. And when you scroll through the portfolio as somebody who is just checking out the fund, maybe not too familiar with dividend strategies, might come across a holding like Royal Dutch Shell, and the first thing you think is, oh, what does this position in an ESG fund? And isn't this a controversy? So could you please explain to us what is the rationale behind owning Royal Dutch Shell, and maybe also what are the pros and cons in your ESG analysis regarding this title?
So once again, just to be clear and to avoid any misunderstanding. So as I told you, those strategies fall into the Article 8 of the SFDR regulations, which mean that those are not Article 9, which are pure sustainable and impact strategies that probably have stricter exclusion rules. Here, as I said, this is a fund that has a financial target, but at the same time, despite having this value tilt, despite being exposed in industrial sectors like steel, like some oil companies, some utilities, we are able, and that's an official target, we are able to offer a lower carbon intensity compared to the benchmark. So I think, as you said, it might appear as a little bit contradictory to have a value tilted strategy and at the same time being able to do so. But if you properly assess the risk, the carbon risk for companies, not all, my point here I want to make here is that not all oil companies are similar, not all steel producers have a similar carbon intensity. And if you properly assess the risk and if you take the specific benefits from some companies versus others, you can end up with huge differences in terms of carbon intensity. And keep in mind that our products, despite having this value tilt, as I told you, we try to have a good sector diversification. So we try to have limited sector tilts. We try to avoid unintended sector tilts. If you exclude systematically all industries like oil, steel producers, you end up with unintended sector risk in your portfolio. And this is something we want to avoid. We want to make sure that the stock specific risk is the major driver of your performance, basically. So again, I mean, as I said, we have exclusion like oil sands, like thermocoal. That's really the first step of our ESG integration process. But you're right. I mean, that's probably a limited part of the universe. But as I said, we have a strong preference for engagement with those companies. And as I said, Shell or Total are companies that on which we engage because we think we can better support them by moving from a pure integrated oil into becoming an integrated energy company. A lot of people do not know, but right now Total already invests 25% of their capex into renewable business. By the end of the decade, Total will be one of the top 5 renewable producers on a global scale. So, I mean, there is a lot of work that is going on. It won't be solved overnight. We have a preference for supporting those companies than just excluding, because if you exclude those companies, basically what it means is that all productions will move to other companies where you probably have less of a control, where you move to EM producers, national oil companies that basically will not have the pressure from the EU to basically transform their business from integrated oil into integrated energy. So again, and coming back to your questions about ratings, it's true that if you look at external ratings, Morningstar sustainability ratings, we know that those companies maybe do not score well versus the broad market, but they score very well, at least the one we own, versus their own sector. And it's really a question, do you want to have a balanced portfolio where you commit to a non-financial targets, lower carbon intensity, but at the same time you avoid unintended risk, and you can really support those companies moving from pure oil into a more integrated energy company. So I think that from the oil perspective, it is very clear that European companies are leaders. I mean, and it's also confirmed by agencies like or external providers like Sustainalytics, you will see that those companies are really leader in their respective fields. But of course, they do not score well if you compare an oil company compared to a tech company or a healthcare company. But we don't want, again, to have our product run by an external score provider. We have a stronger preference for our proprietary score and our qualitative assessment of the risk. Yeah.
Yes, thank you very much, Nicolas. I think that's a good point, because one has to know how the ratings function, what the peer group for these ESG ratings is. And here we have like a part of the universe, the dividend strategies, which has different features in terms of sectors where you find those stocks. Then, for example, a innovation growth fund, for example. So therefore, it makes sense to compare apples with apples, and maybe have targets that are independent from like a certain peer group, like you said, like the carbon target, and also do the engagement with companies that are open for it, which is also positive when a company is open to engage and changes. You might also differentiate between an oil company that is open to change and tackles the issues and an oil company that doesn't.
Yeah, and I think that's important to understand that ESG integration is just more than just having an exclusion. Exclusion is very easy. I mean, that's the easiest way you can do. But what's the added value? I mean, if you exclude all European oil companies, do we get a better planet? I mean, I think that those companies do a lot of work. It won't be solved overnight, but I think we prefer to support those companies in their transition than by just excluding systematically some subset of the universe.
Yeah. Also, let's get back to the sector allocation in the portfolio.
Yeah.
I've seen sector-wise, it looks really diversified to me, and that also maybe making it a bit clearer that it's not purely old economy, because the largest sector in the fund is financial, for example, with roughly 21%.
Yeah.
So this is also my next questions. Could you tell us a little bit about the structure of the fund in terms of sectors, and maybe why you like the financial sector so much, and if there are industries where you find more companies than others?
Yeah, so as I said, we try. It's on purpose that we try to have a product that is very well diversified. We also, of course, we are underweight technology, but we have some exposure to some technology names, because I didn't mention that, but in the beginning I said we don't want to chase the highest yield per se. So it's not a yield maximization process, and we've got some dividend screening, but what our approach has been to use a sector by sector approach, because we know that systematically some sectors will pay higher dividend yield than others, but we don't want, as I said, to be systematically overweight telco or utilities. We're not, by the way. But then by using a sector by sector median dividend yield threshold, we are able to have companies like Capgemini in the IT space, or even Infineon in the semi space, because within their IT space they offer a yield that's attractive compared to the tech space. So that's the first point, and this explains why this is a very diversified portfolio. But indeed, we have some sector preferences, and banks, for example, I think is an attractive sector to be invested right now, not only because of the valuation argument that's very well known, but I think that structurally we start to see an improvement also on the fundamentals. I mean, the last few quarters we've seen positive trends on the fee generation, cost under control, a very strong capital position. So you start to see, you remember last year there was this ECB ban on capital return to shareholders. It has been lifted, and now you see that a lot of the dividends that have not been paid last year are either paid partially or totally this year. And on top of that, you start to see more and more banks proposing share buyback because they are extremely well capitalized. So it's valuation, it's capital return to shareholders, and at the same time, if we are, and I know that still the jury is still out there, but if we are moving progressively into an environment where structurally inflation will be higher, where bond yields will start to move higher, it is also a sector that will definitely benefit from this macro environment. So and on the other side, some traditional dividend sectors like real estate, telco, for example, we are basically underweight those sectors. Either for the telecom space, because we believe that we still don't see enough traction in terms of cash flow growth potential, and despite the attractive yields, we fear that for some names in the space those dividends are not sustainable. And on the real estate, we know that this is a sector that might be vulnerable to rising real rates if indeed that trend that we've seen over the last few months now moves into a more sustainable long-term trend. So again, being a dividend fund does not mean that you systematically are overweight those high diff sectors. And you need to have it's broader than just selecting the highest yield. I think that's one of the key messages for today's webcast. Yeah.
I have a question from the audience, which might relate to the banking sector we've just spoken about.
Yeah.
So how you see the traditional banks strengthened by the fintechs?
Yeah, this is of course one of the reasons why the valuation discount has been so important. So we structurally we need to be indeed cautious about very deep domestic retail banks, because indeed they might face some structural pressures on a medium to long term basis. But at this stage, and looking at the macro environment, the valuation support and the capital return potential, we still believe that if you focus on banks that are more active on the fee generation business compared to NII, this should offer some protection. So again, I mean, it's not that we are structurally overweight banks, and if the valuation discount will be reduced, or if the capital perspective do deteriorate a little bit, we might reduce the overweight for sure. So there is no, we're not there for at any price, any cost. But within banks, we have a preference for, I would say, banks that have higher exposure to fee business versus NII, because I think they also offer better protection compared to fintech, I would say.
Thank you very much, Nicolas. Before we come to the Q&A session with the audience, I have one last question. Because you have been like a dividend fund manager for such a long time, and I'm wondering what your experience was with ESG integration. Did it have some effect compared to your peers on drawdowns, for example, on risk or return, on the dividend yields, on running dividend yield in the fund? Could you please tell us a little bit more about that? What you have seen in the characteristics by integrating ESG into your strategy?
Well, I think that it's the integration of ESG, but also the probably the risk management of the process, where, as I said, we try to avoid as much as possible unintended sector risk or factor risk in the portfolio. I think that those both factors have clearly increased the quality tilt, and as a result, improve the Sharpe ratios of the strategy. So risk adjusted returns tend to be indeed better for our strategies. At the same time, there is a price to pay for that, in the sense that if there is really a deep value rebound, those strategies typically tend to lag a little bit the more deeper value side of the market. But we all know that those episodes tend to be limited in time. And so, again, we prefer the long-term, better risk-adjusted Sharpe ratio as a target, compared to funds that probably either do not manage properly the risk, or basically do not properly assess the ESG risk, and have structural overweight exposure on some sectors where you probably should not from an ESG perspective. So I would say, and it's difficult to quantify if it comes really from the ESG integrations or from the risk management we do in the product, but clearly a higher quality tilt and better Sharpe ratio. That would be the outcome, I would say.
Thank you very much. So I would like to move on to our Q&A session. So you in the audience, if you have a question to Nicolas, just type them in the chat window, and we will get back to them during our Q&A session or after our webinar at the latest. So the first question I have is, how high is the dividend yield of the fund at the moment, and how does it compare to the major indexes?
Well, typically we have a kind of three at this level, we have a typically 60-70 basis point dividend yield pickup versus the MSCI EMU or the MSCI Europe index. So it's around 3.5, 3.6 dividend yield. Yeah. So again, if you look at trackers, because there are some ETFs, either value ETFs or high dividend yield ETFs based on some indices families, they probably tend to show you a higher dividend yield, but it's probably at the cost of a lower dividend coverage. And once again, we prefer to have a maybe on paper lower dividend yield, but still above the market level, but much more sustainable from a earnings and cash flow coverage than those passive trackers. So that's the answer to the question. Yeah.
Yes, thank you for answering this question. It's also something, the quality factor. It's not that you just select stocks with a high dividend, because sometimes a stock that is pretty cheap for a reason maybe has a high dividend yield on paper. So including the quality factor is really important.
That's a good point, because if I may, I mean, historically, if you look at historical performance of stocks that on paper offer you the highest yield, most of the time it is a sign. I mean, typically when you start to see dividend yield moving above 6-7%, it is most of the time a sign that the yield is high because share price has been under pressure, and that most of the time it means a dividend cut is the next step. So watch out for chasing the highest yield. It's probably not the best investment proposition for dividend investor. Yeah.
Yes, definitely, because also statistics say dividends that are cut result in the highest drop in share price, even higher than companies that pay low dividends. So this is the worst thing really that can happen to a dividend investor.
Correct. Yeah.
And that's to avoid at all price. Good. The next one is a question that also bothers me, because we have spoken about banks and the interest rate environment, which is getting better for banks because we all expect a rising rates, not today, but in the future, in the next years. So this is something that wonders me, because like having a running yield of 3.5% is really attractive in a low interest rate environment. But when you're imagining rates to rise, you get more competition in the market for investors' capital, because when you have interest again, you will also get a payout. So how would a dividend fund like yours react to rising rate environment? What do you expect?
It's a good point, because I mean, again, if you go to really yield maximizations, overweight in sectors like telco, utilities, real estate, you are vulnerable in a rising rates environment. But as I said, I mean, this is not the approach we've taken, and it was. I think that the best proof is just to look at the performance of the product over the last few weeks, when you see that this rising rates environment has been extremely beneficial for the product, because as I said, we go besides. I mean, the dividend screen is really the first step of our process. It's much more about fundamental analysis, assessing the cash flow growth potential of companies and the macro environment. And we know that those traditional dividend sectors could be vulnerable in a rising rates environment. But as I said, we are mostly underweight those space. And at the same time, we have decent exposure. We mentioned banks, but also keep in mind that we have decent exposure to some industrial companies. So construction materials companies, companies that are active in the basically more electrifications of the world. Those are companies that offer attractive yield, 3.54%, still trading at attractive multiples. But again, benefiting from this, you could call that reflation story, or rising rates and rising inflation environment. So again, a traditional dividend yield index probably would suffer in a rising yield environment, but our strategy, on the contrary, did benefit, and we are positioned for that. And honestly, this is probably one of the catalysts that would definitely support more the value side of the market versus the more tech side of the market. I mean, we did suffer a lot this year, performance-wise, from being underweight the big tech name in Europe, mostly on the semiconductor equipment side. It was good to see that over the last few weeks, finally, as real rates starts to move higher, those names which are kind of high duration type of stocks finally start to be under pressure. So it is something we hope will continue to happen, because that would support definitely our positioning. Yeah.
Well, then, for now, I think all our questions are answered. So thank you very much, Nicolas, for answering our questions and being here today, giving once more insight in a strategy, in a dividend strategy that integrates ESG and what its particularities are. So I think we are at the end of the webinar. So thanks for being here today. And also to the audience, thanks for being here today. You can find information about the webinar, the replay of the webinar, fund information on our website, www.scopexplorer.com. And also you will find information about the next upcoming webinars from Scope. So it was great to have you here, Nicolas. We had a great webinar today, and I wish you all a good day and goodbye.
Thank you very much. Thank you, Barbara.
Thank you.
Bye-bye.